has to do with financial analysis, which is something you would have taken in introductory accounting. Financial ratios. We're going to obviously do a number of them. We won't necessarily do all 13. We'll do the major ones for determining profitability, liquidity, etc. And we'll compare the ratios to industry averages and see if the company is doing well, if they're improving, if they're getting worse. And so you can compare them to the industry, you can compare them to other companies, and you can compare them to themselves. We'll interpret the ratios, identify what is a good ratio and what is a poor ratio. There are 4 major types of financial ratios, as you can see on the screen: profitability, asset utilization, liquidity, and debt utilization. Profitability. So here are the profitability ratios. There are several of them. This has to do with how much money you're making per dollar of investment or per dollar of equity. It has to also do with gross profit margin, are things like what of every dollar you generate in revenue, how much you actually get to keep. So companies like Apple, their profit margins are much higher than Samsung. So if Samsung sells $1 worth of product, they get to keep a certain percentage, which is a much lower percentage than Apple. Apple has very high profit margins, and in fact, Apple goes out of their way to make sure that people don't know exactly what their profit margins are. It's a closely guarded secret. Asset utilization. How well are you using the corporate assets? As you are aware, assets are used or purchased for the purpose of generating revenue. So we're going to talk about accounts receivable, average collection period. How long does it take to collect your money? Inventory turnover, etc. Accounts payable turnover and accounts payable, which is, of course, the opposite side, when how fast or how slowly can you pay your bills. Liquidity. This has the ability to determine whether the company can pay their bills as they come due. It's a very important ratio. So you have 2. You have the current ratio and the acid test ratio, which is very similar, except it removes inventory, because sometimes inventory is quite liquid, like a 7-Eleven store. Their inventory turns over very quickly and becomes cash right away because they don't have a long period of time between when they sell it and they get cash. But sometimes inventory can sit on the shelf for months, like a jewelry store, or even years. And a watch could sit at a jewelry store for a very long time. So that has some significant impacts on cash flows. Debt. Some debt is considered to be good to a large degree. There's some debate about that. But too much debt is generally assumed to be quite dangerous and can cause your company to go out of business because it relates to the liquidity ratios. They can't pay their bills on time. So how much is your cell phone bill compared to your income? Is your cell phone bill, there may be a portion of your cell phone bill that is fixed, that you have to pay it even if you just put it in the drawer and turn it off, and you have to pay it no matter what. Or like rent, even if you go away for a few days, you don't get a reduction in your rent. So here's just an income statement that you're all familiar with, and we'll do some ratio analysis on balance sheets and income statements. Again, here's just a sample. These are just given to you so that when you look at this, where did these numbers come from? So you have the 2 financial statements. Profit margin is simply your net income divided by sales. So you sold $4 million worth of product. You get to keep 200,000 of that. So you have a 5% profit margin. And that's okay, but it's not as good as the industry average. The industry, for every dollar they sell, is getting to keep 6.5%. or 6.5 cents, and you're only getting 5. So why is yours 1.5% lower? You should, at this, be having another 1.5%. That would be another $60,000 of net income. Gross profit. You can see the numbers on the screen. The $1 million of gross profit divided by the sales, and your company is doing well compared to industry averages. So you want the highest gross profit margin. Now, it may not be obvious in this case, but why is there a difference? We're doing worse on net income, but we're doing better on gross profit. So what you do on the financial statements is look at all the line items that are below the gross profit line and are above the net income line, and you would analyze that. Why are, in this case, a lot of it would be fixed expenses, too much money being spent on perhaps advertising or overhead or some of those types of things, so like fixed overhead anyways. Returns on assets, you can see this company is doing well compared to industry. They are able to generate, for every dollar of assets, they are able to generate net income of 12.5%, and the industry is at 9.75, so they're doing well in that regard. Return on investment, in this particular case, you can see that you can multiply the, it's a variation of the 3.2a, and so you can just multiply to see that this company has got a sales divided by total assets is 2.5. You just multiply the two. And so that's another way to calculate ROA. Return on equity. So for every dollar a shareholder puts in to the company is able to generate 20 cents of income, or 20%, which is better than the industry average. The equity multiplier, you can see total assets divided by equity. So in this particular case, the equity generates 1.6 times as much assets, and of course assets are considered to be good, as opposed to the industry average is only 1.5, so the company is doing better. Same on another way of doing the same thing is when you take the two and you multiply, as you can see in 3.3c, you can see that you also have the 20% and the 15. It's just a different calculation to get the same numbers. I would suggest you just stick with the simple ones, such as total assets divided by equity, and it's a simpler way of doing things. DuPont analysis. In this case, it breaks the return on investment, or sorry, the return on assets into two components. It takes the net income and divide it by sales, which is your profit margin, and it takes the sales and divide it by assets, so which is your asset turnover. You want high asset turnover and you want high profit margins. So when you blend the two together by simply taking net income and dividing it by assets, you can't tell what's causing your return on assets to be good or poor. Is it the poor profit margins? Is it poor asset turnover? So this breaks it into two. It just gives you more detail than simply dividing net income by assets. It was developed by a company called DuPont. Again, here's return on equity. You can follow the formula where you take the net income divided by sales, sales divided by assets, and in this case, then you multiply by assets over equity. And what it does is, again, give you more levels of detail. So you have your profit margin times your asset turnover times the equity multiplier. And you'll need to keep this for one of your assignment questions. So this is just the same thing, but done in a graphic form or a flowchart form. You can see the analysis here. So CP versus CN Rail, which are in the two same or similar industries. CP Rail is not doing as well as CN Rail with regards to profit margins. They're almost identical in their asset turnover, but CN Rail is superior to CP Rail when it comes to return on assets when you multiply the two. Then with the equity multiplier, though, CP rel is far superior to CN rel. So in the equity portion, they're doing more with less. That's really what it comes down to. And you can also see the analysis between Loblaws and Canadian Tire, which may or may not be a great comparison because they have some similarities, but Loblaws mainly in the food industry and Canadian Tire is more in retail as far as merchandising goes. So what it allows you to do is simply compare companies to companies within industries, or just see who should I invest my money in or with. Asset utilization. Of course, it's your goal that for every dollar of assets you have, you want to generate as much revenue as possible. So in this case, in 3.4, for every dollar of accounts receivable, it generates 11.4 times that amount of sales, which is good, which is better than the industry average of 10. Most of the ratios, most of the time, the higher number is better. Probably 80% of the ratios, a higher number is better. One of them that's not, though, is the next one. Just read what it says. It says average collection period. What does that mean? How long from when I sell the product, and of course it can go on to accounts receivable, until I collect the cash. So we all know that the importance of cash. Like when you work, there's a delay until you get paid. How long is that delay? So in this particular case, it takes Saxon Company 32 days to collect, and the industry average is 36. So Saxon is collecting their cash 4 days faster than the industry average. Their accounts receivable department should receive kudos or recognition for what they're doing. They're not allowing accounts to get old. They're following up, making sure their customers are paying their bills on time. We're not allowing some customers to have credit who are slow payers. Now, their inventory turnovers or turns is also good. It's 8.1. So every dollar of inventory is sold completely 8.1 times in a year. So just picture it this way. You have $370,000 worth of inventory. You do not buy any more inventory until it's completely gone. It completely sells out. Then what do? You buy another $370,000 worth of inventory, and you keep doing that. And how many times do you do that in a year? 8.1 times, which is better than the industry average of 7. Your goal is to sell inventory, and you want higher turns. And turns are very important. You know turns. Things like food items, especially fresh fruit and food, need to have very high turns because they're very perishable, but they also tend to have very low profit margins. So that's why the DuPont analysis is important. Again, inventory holding period. You would like to sell your product as quickly as possible. And when I worked in the car industry, it was quite normal to have 90 days of product. A car would come in. What's the average length of time it takes to sell? Would be 90 days. And the managers would go through the list and look at the cars who'd been there longer and identify and provide special incentives to the salespeople to get the car off the lot. Because if the car has been sitting there for 120 days or 300 days, it's becoming, the vehicle may not physically depreciate, but maybe a new model is coming out of that car, and that can drastically reduce the value of the current product. But you want to get your product on the lot or in the store, and you want to sell it as quickly as possible, because then it can sometimes turn into accounts receivable. The same thing with accounts payable turnover. In this particular case, this company is very fast at paying their bills, which is not necessarily a good thing. You may think you're paying your bills too quickly. You want to collect your cash as quickly as possible, but you also want to slow down your bills as much as possible. So you may want to look at that. And I know one company, as soon as they got a bill, they pay it. That's not good. They did this, and we're talking tens of thousands of dollars per item. It was when I worked in the car industry. The accounting person would pay their bills as quickly as possible, and that's poor cash flow management. In this particular case, the company is paying their bills again too quickly. They're paying them in 6 days, not 30. Why are you not taking the 30 days? Like, you're paying your bills 24 days too early. You and I would not normally do that. That's not good cash flow management. Capital assets are like your other inventory items. In this case, for every dollar of capital assets you have, you're generating $5 in sales, which is below the industry average. So maybe you need to look at your capital assets and find a way to reduce them. And again, same thing with asset turnover. It's just the same thing as capital assets or inventory for that matter. And overall, this company with all of their assets is doing a good job of generating $2.50 of sales for every dollar of assets, where the industry is only 1.5. Investors will look at numbers like this. Liquidity, a very critical item as to, again, how quickly or do you have the ability to pay your bills as they come due. So you see, in this particular case, you take current assets divided by current liabilities. So what that represents is Saxon has $2.67 of cash or near cash to pay every dollar of bills that are coming due soon. So and the industry is 2.1, so they have better liquidity. Because inventory can sit on your shelves for quite a while, again, it depends very much on the industry. I used the example earlier of 7-Eleven, which has very fast sales of their inventory. They don't stay on the shelves very long, and all their sales are cash. So they don't go into accounts receivable. So this company, so sometimes you need to factor out inventory because inventory may take some time to sell. So this company has, again, a good ratio. For every dollar of current debt, they have $1.43 to pay for that. The industry is only 1. So they have better liquidity, less chance that they're going to not be able to pay their bills on time. That's really all that it means. Debt ratios are fairly straightforward. You take the total debt divided by the total assets. Companies will have what's called optimal capital structure, which means that they'll have a certain ratio, how much debt they're willing to take on. Too much debt is bad. Too little debt, at least in the past, has been considered not to be optimal either. And some of you in this room or in our course pay attention to that. I'm only willing to borrow a certain amount of money for my education. So let's say, or for a car down the road or a house. So let's say that you feel that it's going to cost you $10,000 for a year of school. Now, how much are you willing to borrow? Some of you say, well, I'm only willing to borrow 20% of that. So where do you get the other 80%? You have to work for it or get bursaries or scholarships or things along that line. Times interest earned. Companies like banks are very interested in getting their money back. But in difficult financial times, as with the COVID crisis, they're very interested in at least getting the interest. Otherwise, the bill just gets larger and larger. So this company has $50,000 of interest, but they have $550,000 of income before interest. So for every dollar of interest, they have $11 of income to pay for it. So they're quite comfortable that way. If their income goes down to half, they still can quite easily pay their bills, and they're doing much better than the industry average. Same thing with fixed charges. In life, you need to pay attention to your fixed charges, how much your rent is a fixed charge, how much, say, a car payment is, whether it be a lease or borrowing, all your other fixed charges, and how much money do you have. So this company, with the fixed charge ratio, they have $6 of income for every dollar of fixed charges. So what that means is if they have a bad quarter or a bad month or a bad year, and they only make $300,000 rather than $600,000, they still have a $3 of money to pay their bills for every dollar that they owe, because you can't get away from fixed charges. It's something companies pay a great deal of attention to, and you should also. They're doing better than the industry average, which is 5.5. And here's just an overall summary. And you can see for yourself below average, and I'll let you read the rest on your own. And we did go through that when I was presenting it. So I hope that's been helpful. And we will, in chapter number 3, have several examples for you to do during the discussion about the chapter. Have a great day.